Good morning. Seeing a number of you just join in their numbers, so that's great. Welcome. Thanks for joining. Hopefully you can all hear me. If you can hear me, just send me a message. So today we are delivering my summer tax masterclass, and what a great time for us to be together discussing what can be done within UK taxation. We have an interesting budget coming up next month, and essentially it is becoming tremendously difficult to shelter tax and essentially know where to go, what you can do. So I'm really looking forward to sharing some knowledge with you all today, and hopefully you enjoy the session. I'll be aiming to talk for circa 40 minutes or so. That will allow enough time for questions towards the end. We will have time for a Q&A session towards the end. But I appreciate your time today, and thank you very much. One question I get asked straight away is this being recorded? And it is being recorded. If you've automatically registered, you will get a copy via email over the next day or so. There is a chat function, although all chat and messages are private. So if you'd like to message me, then please do so via the chat facility. And of course, there is a Q&A towards the end of today's session. So as we're going through the relevant slides, if something comes up, then please essentially put that in the Q&A box, and I'll cover as many questions at the end as possible. Also, I will be offering 10 free consultations. So I'm going to post a link in the chat bar now, which hopefully everyone will get. So if you'd like to take advantage of one of those 10 slots, you can book in a consultation on any given day. That will be a link to our calendar, and you can book in a consultation with us just via that link, which will close shortly, and I'll repost it towards the end of today's webinar. So just so you're aware, my company, most of you I'm assuming will know me as Mitch the Taxman, but my company, which I created, is called the Fusion Consulting Group. Whilst we're known for our tax advisory work, we're multi-award winning, my vision is essentially to create a professional services group for clients. So they have in-house tax advisors, accountants, lawyers, financial planners, CFOs, all within the one company. And that is what I believe is the future of professional services. So if that sounds interesting to you, then I'll be happy to explain that to you at another time. But essentially at this point, it'd be interesting to run a poll of, are you happy with your current accountant? So what I get a lot of, certainly in terms of tax advice, is that my accountant is not proactive, he is proactive, etc. They don't understand what can and can't be done. But it'd be good just to get a market view of what the current theme is around whether you're satisfied with your existing accountant or not. As we just begin the session, I'll just leave it going for a couple more minutes. Because essentially what happens typically is if we do some tax advice, then we have to explain it to someone's accountant or their financial planner. So the idea of having everything in-house is that I can deliver the tax strategy, and then essentially the whole team internally will have that to hand and ready to implement. So we've got hundreds of people on today's webinar. And I'm just going to end the poll now. So hopefully you finish. And what the findings show that 60% of you are not happy with your current accountant. 40% are, which is probably around, I think, the national trend in what we see anyway. So yes, thank you for that. Okay, so today's session, I'm going to cover these core themes. So what we're going to look at is inheritance tax, particularly around business property relief, agricultural property relief. Property taxation, we know, a key area, very difficult holding property and being tax efficient with it. Under labour, corporation tax and cash extraction, what are the techniques that can be used around that? And we will then look at the brief analysis on some self-employed changes, and that will lead into my slide on making tax digital, which is a big change. I'm then going to finish the last two slides on residency. A lot of my calls are essentially about potentially leaving the UK, what can and can't be done. Very quick slide on budget predictions, because it is just a prediction. And then we'll come on to Ask the Expert and the Q&A session. As mentioned, as we're going through, please pop the Q&A into the bar. Also, if you'd like to email me, you'll see my email address on screen. So again, if you'd like to discuss something a bit more personal or related to your business and you don't want to ask a question on the forum, you'll see my email address dotted across the slides, mitch@fcg.co.uk. Feel free to send me an email with analysis of your situation, and I'll get back. Yeah, I'll get in touch with you. For those that don't know me, my name is Mitch Young, known on social media as Mitch the Taxman, award-winning tax advisor, co-founder of the Fusion Consulting Group. For those who don't follow me on social media, you can do at Mitch the Taxman. Thank you for all the messages which are coming through, which is going to be difficult to read as we're working, but thank you very much. Okay, so inheritance tax, big changes coming. But first, let's just talk about the two core reliefs, which are still very relevant to one's tax planning strategy: agricultural property relief and business property relief. Agricultural property relief essentially offers 100% inheritance tax relief on agricultural property. It applies to land, farmhouses, cottages, and associated agricultural buildings. The ownership conditions include it must be owner occupied for a minimum of 2 years, the let property for a minimum of 7 years. Where there's been traps previously in the past has been around the farmhouses. Case law has determined they must be character appropriate, in inverted commas, and that's essentially where there's been traps. Business property relief is quite similar. It offered 100% inheritance tax relief on qualifying business assets. Qualifying assets include unquoted shares, interest in trading partnerships, and sole trader business. The business must be owned for at least 2 years prior to the death, and it must consist of wholly business trading activities and not investment activities, i.e. investment activities can't equate to 50% of the actual business. Often there's an interaction between agricultural property relief and business property relief, particularly, of course, if you have farms. If that works, then essentially you would take the agricultural property relief first and then the business property relief second. So where people get caught out, I've mentioned about the farmhouses, but also around the trading and investment. So you may be sitting there with an actual trading business, but you may have merged the lines, i.e. if you have a substantial cash balance at death, for argument's sake, that could disqualify you from business property relief. Or if you have one trading business and you may have invested within that business, say into different types of investments, you may have invested, say, into real estate, then essentially that could disqualify. So essentially, it's always very important to look at the conditions year on year out in terms of your qualification for agricultural property relief and business property relief. Now, essentially, from April 2026, which is coming up, Labour have changed the rules in regards to this relief. So essentially, what it is now is that previously there was 100% uncapped relief on the valuation of the assets. So a lot of business owners, certainly farmers and farmland owners, didn't particularly have to be too concerned when it came to inheritance tax. But of course now, for the vast majority of the clients and people I speak to, businesses are the shares in the businesses are essentially worth more than £1 million, and this is what they've capped 100% relief on. That first £1 million per individual is capped, where you get 100% inheritance tax relief on death. Over and above that, essentially the tax will be at 50%. So you get 50% relief, which means that you'll be taxed at 20% on the remaining value, both from a business property relief perspective and an agricultural property relief perspective. The other changes coming in is around the pensions. So essentially, from April 2027, the unused pension funds and death benefits will be included into a deceased estate for inheritance tax purposes. Again, this is a huge change coming in, where previously you could pass on your pension to the next generation free of inheritance tax. HMRC expects to bring in 600 million extra revenue in the tax year 27-28, and this will affect 31,000 estates, rising to circa 66,000 estates by 29-30. In terms of pensions, there's a big double taxation risk to bear in mind. If the pensions are drawn out post-death, then potentially you could be combining a 40% inheritance tax on the remainder and then a 45% potential withdrawal of the pension, which could create an effective tax burden of around 67%. So essentially, there's no magic wand. I can't sit here with a magic wand, but a lot of clients are now looking at their reevaluating their inheritance tax strategy, understanding what can and can't be done in terms of pivoting. So of course, a structure that we look at quite regularly in terms of inheritance tax is the family investment vehicle. More and more we're looking at that, and I'll talk about that as we go on through today's masterclass. And essentially what we're doing predominantly within the family investment companies is that we're looking at sheltering outside of the estate. So particularly where you have young families, i.e. where the main directors and shareholders are essentially in their 40s or 50s, the future growth, they can continue to invest and grow their businesses and their assets, so the future growth is sheltered outside of inheritance tax. Of course, we look at trusts. Trusts are tremendously important in terms of asset protection, but as well as inheritance tax protection. We don't want to be lumbering everything into a trust, because a trust has its own taxes and tax situation to be aware of. And, I'll cover that maybe in another masterclass. So it's really about the agility, about looking at a number of different options. Lifetime gifting at the moment, there has been rumors around this as well, but lifetime gifting is still a good strategy to look at. the more you can get out of your estate, the better. But of course, need to consider the capital gains tax implication of gifting. Gifting of monies results in no tax, immediate tax. Just to say, the business property relief, agricultural property relief, and pensions has essentially already been announced. So that is coming into force. When it comes to property, it is tremendously challenging, and I fully sympathise with property investors out there. In terms of some recent tax changes that you may or may not be aware of, so a lot of our investors were looking at the furnished holiday let as a strategy. Essentially, the reason why one would do that is partly because they would benefit from tax reliefs in terms of the same as business tax reliefs. So essentially, if you sold the business, you could qualify for business asset disposal relief, the capital allowance regimes, and more and more. So this has now been abolished from April 2025. So there is planning that a lot of furnished holiday lets are looking at in terms of shall they now incorporate their businesses, and essentially it could qualify as a business. So then we'll be looking at moving the furnished holiday lets into a limited company as an alternative structure. As the property investors listening will know, that it's not as simple as just to incorporate properties. One, you need to understand the tax impact, whether it qualify for tax relief or not, in terms of the capital gains tax, the rollover into that. And two, financing. We can look at tax advice. We have looked at tax advice for a number of property investors, but it's important that this is aligned with the lending criteria as well. Often when it comes to debt and certainly the different mortgage companies out there, banks, etc., it's unlikely you'll get exactly the same terms as if you were as an individual investor. You have to look at this as, okay, for the long term, you might be in a new structure which will be more efficient. However, it may be slightly more expensive to achieve that. And it's important you have those conversations with your debt providers up front, as well as obviously the tax situation. We continue to suffer from the Section 24 mortgage interest restriction. Most of you will know you cannot deduct the full amount of mortgage interest in terms of computing your trading profits if you own the property individually. So again, more often than not, people are establishing companies to own properties, and some people are being put off property as an investment as a whole. But certainly, if you're a higher rate taxpayer, you intend to hold property as an asset class moving forward, then it's wise to look at a corporate structure if you're going to get debt against it, because within a corporate structure, i.e. a limited company, you'll be able to offset the full amount of mortgage interest in computing the trading profits and therefore paying tax on the true trading profits. It's hard for people to pay tax on artificial profits when they own property individually as buy-to-lets and they're a higher rate taxpayer. It doesn't particularly make financial or commercial sense to operate in that manner. There's a lot of taxes that get missed or misunderstood when it comes to property: stamp duty, land tax, ATED, capital gains tax. The one I want to focus on is the ATED. The ATED stands for the annual tax on envelope dwellings. So we're talking about owning property within a limited company a lot. A lot of property investors have pivoted into a limited company, setting up limited companies. Now, the ATED pretty much exists as a dry tax charge for when you own property within a limited company, and it's valued above £500,000. then essentially this qualifies for an ATED tax charge if the property is not rented out. So what it means is that if you own a residential property that's owned within a limited company and it's valued above £500,000, there's an annual tax on envelope dwellings. Now, this is essentially tiered to the value of the property. So, for instance, if your property is valued between £500,000 and £1 million, then essentially there'd be an annual tax charge to pay every April of £4,450. If it's valued between 1 and 2 million, then essentially it's £9,150. 2 to 5 million is £31,050. Now, if you rent out the property on a commercial terms to a third party, you don't have to pay the ATED tax charge. However, there is an annual tax return that would need to be delivered every single year by the 30th of April, called an ATED tax return. So even if you've been renting it out to a third party, you need to claim the relief on an ATED tax return and submit that to HMRC. Failure to submit these returns will result in automatic statutory penalties. The reliefs include commercially let to unconnected third parties, is open to the public for at least 28 days per year, is held as a trading stock by developers, farmhouses, or employee accommodation and social housings. There's exemptions to charitable organisations and public bodies. So for those of you who might have owned property within a limited company and it's valued above £500,000, then you should submit your tax returns. If you do have a backlog, I would advise submitting those as well. The tax charge basically comes in when you're using the property within the company for, say, family members or connected parties. Okay, this is quite a big topic, so I'm going to go through a number of different points in terms of corporation tax and business owners, okay? First thing we're going to look at, obviously, we know the corporation tax, the main rate is at 25%. Dividend rates and extraction policies. So dividend tax rates from 25-26, the basic rate is at 8.75%. The higher rate is at 33.75% and the additional rate at 39.35%. With corporation tax at 25%, the gap between taking a bonus or a salary or dividend is quite marginal these days. The decision in terms of what the exact mechanisms one should take will really depend on an individual basis. It will depend on your personal income levels that you need, the national insurance contributions, of course, and the savings that can be made there, and the company cash flow strategies. All of that would need to be weighed up in terms of what would be the most tax efficient thing for you and your business. A lot of our clients now are taking more of the salaries and less of the dividend in terms of a higher salary, less dividend in terms of a policy. The use of family members is still going to be an important strategy, particularly if you are married. You can obviously use your spouse or civil partner and their various tax bands in order for an efficient tax strategy, tax efficient strategy. So that should, of course, always be looked at as a basic starting point. When we're talking about children and potentially using your children, there is settlement legislation in place. There's a big case which is constantly reviewed called the Arctic Systems case. And this should be looked at in terms of how children were used in terms of the settlement legislation. Essentially, it will be very important if you are going to have children involved as family members that it doesn't be perceived as income shifting. where dividends are disappropriate to the shareholding value. So if you are going to have your family involved, it is tremendously important that you document everything. You have a very well written family shareholders agreement in place. And this is the key thing really with a lot of tax and HMRC, is that you get your ducks in a row, you do things properly, you get all the documentation, you get the planning and everything that backs up the planning. And that has been proven when something does come to investigation or case law to work in the taxpayer's favor. And of course, it's worth considering when children do turn 18 to potentially look at gifting them shares from a tax efficiency extraction perspective. But then we look at succession planning. So when we look at succession planning within businesses, we're looking at gifting of shares, management buyouts, trade sales, employee ownership trusts, or indeed liquidations. Employee ownership trusts are proving tremendously popular due to the variety of tax reliefs and exemptions, providing that all qualifying conditions are met. So this isn't something for everyone, but certainly it's worth considering as part of a succession plan exit strategy for business owners, which should be looked at because there are still a number of reliefs available within certain structures. You've got the company purchase of their own shares as well as a taxation strategy. This enables the taxpayer to essentially exit the business with potential very favorable capital gains tax treatment. To qualify for this, it must of course be a trading company, as with all sorts of tax reliefs, and the seller must hold shares for 5 years as a minimum and must resign as a director. Selling your business generally, we're seeing a lot of activity in the M&A space, particularly, as business asset disposal relief gets increased year on year. Currently, when you sell your business, sell your shares in a trading business, and you meet the conditions, you can benefit from paying tax on the first £1 million at 14% in this current tax year up to April 2026. That's changing to 80% from the following tax year. This is compared to obviously the main rate of capital gains tax, which is at 24%. We've mentioned employee ownership trusts, and just so you know, within an employee ownership trust, capital gains tax-free disposals if more than 50% of the ownership transfers to the trust. So this could mean that you could potentially sell your business or exit from the business and essentially not pay capital gains tax. The downside, or one of the conditions to an employee ownership trust, is that all employees must benefit equally and control must remain with the trust for 4 years post-sale. So we have dotted around a few different strategies. The key thing is to plan early. And if you are going to look at a different type of structure, when we talk about paperwork, be it an employee ownership trust, purchase of shares, transfer of assets, or essentially a group, then essentially it's always useful to seek HMRC advance assurance or clearance, whereby you can write to HMRC Reconstructions Unit, explain about the reorganisation or restructure, and they would confirm whether they agree with your planning. One of the key operations at the moment is about establishing groups for tax efficient purposes. This is something we model out for business owners, and essentially what it means is essentially a corporate group where you have a holding entity owning the trading entities underneath. A group exists where there's 75% or more direct or indirect shareholding, enabling group relief. And what it means is that you can maneuver dividends around the group. So instead of extracting monies personally from the trading company, you could pay a dividend to your holding company, without having to pay any income tax, obviously, within that transaction. There's no corporation tax on the dividend movement. And then you can reinvest or move the monies into an investment strategy. The other great thing about establishing a corporate group is that if you were to sell your trading business and it meets the qualifying conditions, because it's held within a holding company, it could qualify for substantial shareholding exemption, SSE. And that would mean the transaction on selling the shares of the trading business and moving the monies into the holding company would result in 0% capital gains tax. You could then, of course, look to reinvest the proceeds, etc., in a tax-efficient environment. You must hold the shares in order to qualify for substantial shareholding exemption, you must have held the shares for 12 months prior. This planning works very well when you're combining your corporate group strategies with your family investment companies. Of course, what you need to consider is that if you want to extract the monies personally in your back pocket, there of course will be a dividend or a tax to bear in mind. Just to say, if there are any business owners who are on this and listening, want to map out that strategy, you'll see my email on the screen throughout the slides today. And for those who have joined late, please ensure if you do have questions, then essentially put them in the Q&A box and I will answer them as we go along. And there is the chat going on if you want to send me a message as well. Okay, so very briefly, for those self-employed individuals, we've got the Class 2 National Insurance has been abolished. That was done last year. Class 4 NICs are cut to 6% last year as well. For those operating as self-employed, the cash basis has become the default method in terms of your accounting policies. And there's the basis period, which has been reset to align with the tax year, which is the 6th of April to the 5th of April. So that will be how you account for your income moving forward on any given year, aligned to the tax year moving forward. So there may be some apportionment going on if your accounting period did differ, or if you set up in a different way. And transitional profits between the accounting year and the tax year will need to be managed moving forward. So speak to your accountant on that. Just to go over very briefly the expenses. So there's been a few changes there, but the main one, as we know, in order to qualify for expenses to deduct against your trading profits as self-employed, must be wholly and exclusively for business purposes. Key allowable costs include your usual business travel. One thing which has changed has been training. Training has been allowed for existing skills or upskilling as proven. Disallowed items often include client entertainment, personal clothing, and some personal fines. Travel is always one that gets misunderstood. Travel to the base of operations is not deductible. Travel between locations is. Mileage claims are optional. You can do HMRC's fixed rate at 45p for the first 10,000 miles and then 25p after. Working from home, you can claim the running costs at a proportion or a fixed rate allowances up to £26 per month. But be mindful of the capital gains tax implications in terms of if you're using your main home as your office, it could disqualify a proportion of principal private residence relief. And very briefly, just on making tax digital, this is obviously a huge change coming in to the world of taxation. So from April 2026, it's mandatory for self-employed individuals and landlords with income more than £50,000 it's mandatory to operate Making Tax Digital. From April 2027, this extends to those, as I've said above, with income of more than £30,000, and from April 2028 from income or earnings above £20,000. HMRC has been writing to all affected taxpayers from April 2025. And essentially what it means is that instead of doing one tax return a year, there'll be quarterly submissions required for each business's and property portfolio. Combined UK properties will be submitted in one report. Overseas properties will be in a separate report. Submissions will be cumulative. Reports must include both income and expenses. Software will be key to this. The HMRC Gateway will no longer support Making Tax Digital reporting. Bridging software and Excel can be used in certain scenarios. So if this applies to you and you don't have an accountant, you need to obviously get ahead of that. If you do have an accountant, then they'll be in touch, no doubt, to assist you. So you'll have these quarterly submissions, and then there'll still be an annual return which would need to be filed, which replaces a traditional tax self-assessment tax return. But the annual return should be a lot more simplified. And the annual return will include all your income sources. So that will include not only, of course, your rental or trading, but obviously your bank interest, dividends, etc. Couple of softwares that I would recommend, one of which is Dext. Dext is a great tool to pull together all your sort of bookkeeping. If you go on my social media page, there's a link to a discount for Dext as well. So that will help you get ahead of the game on there as well. Xero, of course, we continue to recommend as well. But if you're unsure, then I would recommend speaking to your accountant. Okay, so with the current state of play in the UK, a lot of families and business owners are potentially thinking of leaving. And essentially, you know, it's about understanding what can and can't be done. So a lot of people will want to leave, but spend time still in the UK. So in terms of your personal residency position, the UK is governed by a piece of legislation called the statutory residency test. That will determine in any given tax year, so you look at it on a tax year by year basis, whether you're UK resident or non-UK resident. If you're UK resident, you're going to be subject to UK tax on your income and gains that you make throughout the year. If you're non-UK resident, then you're not subject to UK tax on your income and gains that you make in the year, unless it's a UK qualifying asset such as property income. So in terms of that, the statutory residency test has a number of tests. They have an automatic test, and that will determine whether you're automatically UK resident or automatically non-UK resident. There's two, which most people know about. The first is if you spend 183 days in the UK in any given tax year, you're automatically going to be classed as UK resident. The non-UK residency one is if you work for an overseas employer, you can spend up to 90 days in the UK, of which no more than 30 days can be working. And then if you don't meet any of those criteria, you have what's called the sufficient ties test. And that will basically look at a number of ties in which you have to the UK. And then depending on the number of ties in which you have to the UK, it will give you a branch of days in which you can spend in the UK. So that essentially will look at your income and gain situation. We then look at corporate residency. So, you know, there's a lot of entrepreneurs out there who will be like, okay, well, we want to move our business to another jurisdiction for tax reasons or commercial reasons, and that's absolutely fine. And it's about investing time in the region. It's about ensuring that all key decisions on a day by day, month by month, year by year are being done in that region. The effective control and management is happening in that region. So what essentially won't work, because there is an anti-avoidance in place, is that you just quickly established, say, a company in Dubai, for argument's sake, and you spend all your time in the UK as a one-man band, but you're just moving your bank account and trading into that UAE shell company. That will fall foul of all sorts of anti-avoidance, and HMRC, even though legally it's a UAE entity, will look to tax that and bring that back into the realms of corporation tax. So it's important, if you did want to establish a non-UK residency plan and pathway, you actually understand and see if that can meet your requirement. Of course, the other thing that they want to avoid is that even if you become non-UK resident personally and you do meet the criteria, let's say you become non-UK resident, you want to extract £1 million from your business, you wouldn't be subject to tax on that £1 million because you're non-UK resident. And then you're like, okay, well, that's great. I've extracted £1 million, not paid tax. I'm going to come back to the UK in year 2. You won't be able to do that because there's a piece of legislation called the Temporary Non-UK Residency Rules, which essentially means that if you sell your business or assets and made a gain, or if you've declared a large UK dividend, you have to essentially remain outside of the UK for 5 complete tax years in order for when you come back for that amount not to be subject to tax in the UK. So again, that's an important condition that you look at. And finally, in terms of residency and inheritance tax, we've seen a rule change in regards to the non-domicile regime. Previously, if you were non-dom, you'll be able to take advantage. Now, essentially, inheritance tax is governed by residency. And if you've been residency in the UK for a period of time, regardless of where you were born, you're automatically going to be classed as resident and essentially previously domiciled, and therefore your estate will be subject to UK tax. Even if you become non-UK resident, you'd have to break the residency cycle in the UK in order for your worldwide estate not to be taxed in the UK. So essentially you could be non-UK resident for 2 or 3 years, not pay tax on your UK income and gains, but still you would be caught by UK inheritance tax on your worldwide estate until you break that consecutive cycle. Most cycles are usually 10 years unless you meet other conditions. So again, careful consideration in regards to inheritance and wealth tax planning needs to be considered. But just generally, it all needs to be considered. And if you are looking at a residency, non-UK residency policy, make sure you're documenting everything, every travel date, how many days you'll spend in the UK, have it all backed up with key evidence. So in terms of trends, what we're seeing a lot of reorganizations. We're seeing a lot of planning. We're seeing a lot of people come to me and to reevaluate their tax position, be it inheritance tax, be it corporate restructuring, or indeed just overarching strategies. We're looking at sheltering capital in terms of still capital remain at a lower tax rate. We're looking at seeing families look at their businesses and their trading assets, and a shift to trusts and family investment companies. I am seeing quite a big trend about people leaving the UK. I have probably around 5 calls a week on that as well. Okay, just finishing up, so please get your questions in. Yeah, look, a bit budget predictions is quite difficult. We've seen a plethora of rumours. But what we do know is that there will be a couple of announcements where taxes will increase. Do we believe there's going to be a wealth tax at one point? There was heavy rumours about that. I can't personally see that coming in. There was another article on it last week about it, but I just can't see that coming in. Pensions, I think, are going to continually be looked at. the lifetime allowances, what can and can't be taken. I think we'll see some changes around that. Capital gains tax, it's been rumoured for a while that is going to be something that be looked at. We've seen her increase the business asset disposal relief. It will not surprise me in the slightest if the general tax rates of capital gains tax continues to increase on a percentage basis over the period of government as well. There has been rumoured this week as well about taxing lifetime gifts as well. So potentially we could see another change to inheritance tax around the lifetime gifting. 30th of October is when it's set for. So I'll be doing a webinar shortly after to go through some of the key changes announced. Some key takeaways I want you to consider. 1, planning. Planning is absolutely vital in terms of not just coming up with one plans, but brainstorming a couple of different outcomes to see if that can work and maneuver for yourself. Get compliant. If you're not compliant, it's imperative. HMRC have huge amounts of resource at their disposal, so really important that you comply with literally everything and anything. Documentation is key. Proper documentation. If you are going to get advice, if you are going to reorganize, don't just leave it at that. Make sure you get a solicitor to do the proper drafting, the drafting of the shareholder agreement, the director's loan strategies. If you are traveling, document that. If you are gifting to people, get a letter of wishes or gifts done, wills in place, trust deeds. Documentation is fundamental. And very briefly, just what I do, why we're quite unique in the market is, I model. I don't just look at advice on a transactional basis. I'll sit with you, we'll work out the future in terms of your future plans for your business and your family. And then I'll essentially model out different options and scenarios, put that down in writing, look at the short, medium, long-term effect, look at the implications. And then together we'll agree on the right strategy. And then I'll draw out the actual agreed master structure or master plan that's right for you, your family, your business. And then we'll work on that plan, tweaking year on, year out, or give those plans to your existing accountant. So you have a very clear, agile, efficient pathway of operating in the UK in the current world. I charge a fixed fee rather than an hourly fee for that process. So if you'd like to arrange a consultation with me, then please feel free to do so. My email, you've got my email. If you want to be a bit more sort of personal, I'll put it in the chat as well now. I've put put in the link as well, a link whereby you can book in at convenient time for my colleague to reach out to you and then book in a call with me if relevant. I do think it's very valuable. There's no, as I said at the start, there's no magic wand, right? And a lot of what I do isn't rocket science. It's not this crazy, tax avoidance scheme. It's about problem solving, being agile, saying, okay, well, we can't do this, but if we move this here, what would be the tax and financial implications of doing it? And that is where the time cost comes in. In terms of general, so I operate fixed fees to deliver that project, which we scope out together when we have our meeting. But generally, of course, we operate as traditional accounting and tax practice, where essentially we do great proactive accounting advice, general tax returns, etc., where we charge a monthly fee depending on a monthly retainer, depending on what's involved, whether we're going to do bookkeeping or not, etc., etc. So for those who don't feel they need that level of written advice, you can come on board with us as just general accounting and taxation clients, where I'm sure you'll enjoy a different type of service to maybe your traditional accountant. So again, just drop me an email and we can arrange a time to speak. So I'm going to come on to a Q&A. I haven't looked at any, so just because obviously I've just been spurting away. So just just give me a moment to go through some questions and comments, and I will I'll try and go through a few of them. But in the meantime, if you want to listen in, please prepare an email to me in the meantime, introducing yourself, your businesses, your set of circumstances, and we'll go from there. Oh, sorry, let me just... I'm sorry, I put on the chat now the link to booking the consultation, so you should have that. It was on the Q&A part. Okay, so Nick, will a full-time landlord qualify for business property relief? Great question. I would probably say in the first instance, the default answer is it's unlikely, but we would need to look at, obviously, how many properties you're operating, whether it's sole trader or not, etc., etc. So each case to its own. But if you have a general buy-to-let investment portfolio, it's unlikely it would qualify for business property relief. How easy, Jay-Z has asked, how easy is it to transfer property asset from the personal name to limited company? In terms of the actual mechanical elements to it, the legal drafting, the conveyancing, that's all that needs to be done. In terms of tax, that would be documented on your tax return. So all the professionals can take care of that. I think the trickier part is the lending part, where if you've got a mortgage on that, you'd need to speak to your mortgage provider and look at options in and around that. Liz has asked, is the tax for property, so this is in relation to the ATED, is the tax properties over 500,000 going to be in addition to council tax? So yes, the ATED is going to remain, and essentially it's on the value, it's on an April value. So every 5 years you look at a value of the property, and if that property is essentially worth 500,000, then essentially it will qualify for the ATED, and you need to complete an ATED position. Tax return. Sorry, there's just like 50 questions here. How is inheritance, JJ has asked, how is inheritance taxed on a group structure? Great question. Great question. So, I mean, this will come down to whether you have a trading business or an investment business. If it's a trading business, then essentially it will follow the same policies as the business property relief, as we mentioned. So you would get £1 million, 100% tax relief. Obviously, if there's 2 shareholders, directors that qualify, you'd get £2 million. But the idea of a group structure, a family investment company, is that over the course of a lifetime, X amount of shares are transferred, or the value is transferred to the next generation. So by the time of death, you own X, which means Y, which means X amount is not qualified in your estate from inheritance tax purposes. But yeah, thank you very much. Good questions. Getting lots of emails through, so thank you. I'll put my email again and the link to book in a consultation. I think we have 2, my colleague's telling me we've got 2 spots left for the free consultation on the link. So put that on again. I'll hang on for 5 more minutes, start a few more. Where was I? What are your limited company charges? Yeah, our charges begin around the £200–250 per month mark on the accounting side. I'd say we're middle of the road, but for that you'll be getting a different type of value and service than maybe your one-man band accountant. Karen has asked, hi Mitch, you mentioned that some directors have switched to higher salaries and reduced dividend withdrawals for tax efficiencies. Can you explain? Yeah, I mean, it just means that traditionally, if you were a limited company director, you would probably take a small salary up to the NIC threshold or your personal allowance, and then the remainder as dividends. Whereas now people may take a salary of, it might be 50,000, it might be 100,000, or just shy of the 100,000, and then just top up with dividends because, it makes more sense for them. They can offset their salary, reduce the corporation tax bill, and it's just simpler. So for the savings of a few £1,000s, it may make sense for that business and person, but it depends. Each and every scenario depends, as I mentioned. Kate has asked a good question here. I have a limited company. Where does my accountant versus my IFA versus you as a tax planner overlap in terms of service provisions? Yeah, it's a good question. And this is why we've created our company, where we've got all those key advisors in-house. I would say initially a lot of people come to me for the tax strategy and tax plan, which, they've never received. The accountant might not have the time or expertise to write a full tax strategy document to what I do. So you may look at that as a silo and then have your accountant and IFA just manage the outcome of a reorganization. Often it may be that the accountant does the general day-to-day, and some people may pay me a retainer just to dip in and look at advise on just tax on an ongoing basis in line with your accountant and IFA. But it really depends on the situation, what tax advice is needed, etc. Hashem has asked, how much do you work with other accountants and other professionals who are looking to support? Absolutely. So for those accountants or professionals who are on board listening, we very much work with other accountants who may not have the time or expertise to write or advise on tax. We're very respectful of everyone's clients and individual relationships. We're happy to include you as much as possible within the process. So yes, we'd welcome the opportunity to work with more professionals, more accountants. For those on the webinar today, the consultation will be with myself. My colleague will essentially be in touch just to qualify, get the notes, and then book it in with me. Jeremy has asked, I invested in a company through SCIS scheme. Yep, absolutely. EIS and SCIS are still out there, haven't really been changed too much over the years. So if you are looking, if you have surplus income, you're looking at tax efficient strategies, then absolutely investing it into tax efficient vehicles such as enterprise investment schemes, these enterprise investment schemes will essentially mean that you get some income tax relief, 30 or 50% on the investment, and essentially potentially if you hold the investment for X number of years, you sell it, capital gains tax relief. So yes, absolutely. Right, I'm just pasting the link again. Can everyone see that link, that Fusion Tax Consult? If you click that, you'll be able to book in a time slot that works for you for the free consultation. That bit.ly, hopefully everyone can see that. This webinar is being recorded. Absolutely. Thank you for your questions. If you do have any further questions, please email me. My email is very simple. Or for those that did enjoy today's webinar, you may want to essentially post something on social media, and I will happily repost or tag you with some feedback. Absolutely. We want to help as many people as possible. It's not easy out there. So do get in touch, even if it's just a touch base to see whether we can or can't help you. Absolutely. I will be doing a lot more webinars as we go on. There will be a recording of this. Look out for our upcoming newsletters across a multitude of events across my company, which is Fusion Consulting Group as well. Any feedback is appreciated. If you can't book it using the link, it may have expired now. So the best thing to do is just to drop me an email, say you'd like to arrange a consultation. My email is in the chat bar or on screen now, and we will pick that up. But I would advise, if you have a business, if you have families, then either of those, I would advise to get in touch with us and have a consultation ahead of this tax year. Changes are coming in April 2026. So let's act now. Let's do some planning. Let's get you the advice ahead of the budget so we know quickly when to pivot, when to not. So we're hitting the new year with a strategic tax plan, sheltering inheritance tax, corporation tax, and getting it done for you. So 11 o'clock, 1 hour. Appreciate your time. Thank you very much. I do really appreciate feedback. I do really appreciate you getting in touch. But for now, have a wonderful day, and I'll see you on the next one.